Hi, it's Richard Hemming here from Under the Radar Report. I'm here with our Chief Mining Analyst, Peter Chilton.
Hi, Richard.
Hi, Peter. It's great to see you. It's exciting because today we're talking about commodity stocks, mining stocks. Mining stocks really can change your life. I mean, you buy the right mining stock, it can transform your wealth. I just got off the phone to a subscriber who bought a lithium stock, Vulcan Energy, which I think you recommended, Peter. And that has just changed his retirement savings, so that he's now comfortable. Unbelievable. For me, nuclear stocks have really made a big difference, as has, in the past, gold mining stocks. And I'm sure, Peter, you've had some stocks make a big difference because you've been literally at the coalface. Why don't we start by you talking about what your experience has been in mining?
Well, I did mining engineering at university, and then I spent a number of years working in the mining industry in a number of countries, underground and open pit, in a range of commodities that included iron ore and coal and gold.
Yep.
Then I moved over to working as an analyst for a number of stockbrokers,
Yep.
including some quite large stockbrokers.
Yep.
Before moving on to funds management,
Yep.
managing money. And then I continued my investment research with a number of other different companies, including now Under the Radar.
Well, I mean, basically, Peter's got experience and he's been through a lot of cycles. And today we're going to be talking specifically about critical minerals. But Peter, what's interesting at this point in the cycle, from your experience?
Well, I guess one of the things regarding commodities is that a lot of the commodities are due to the energy transition to
Yep.
renewables. So a lot of commodities are one way or another associated with that. At the same time, some of the commodities are affected by what's going on in China, not only from a demand perspective, but China's also a major supplier of some of the commodities that we look at. And then finally, technology is changing the way we use commodities positively and sometimes negatively. So that's also something to look at and take into account.
Well, we're going to be talking more about stock specifics, but first we're going to drill down on one sector that's really hitting the news, and specifically I think a lot of stocks are getting sold off, and that's uranium/nuclear, because I think Kazakhstani supply has really ramped up, and that's affected those companies' share prices, I think, with some big falls. What would you say about that particular piece of news?
First, I'd say it's all been a bit of a beat up, really, without a lot of substance. In actual fact, Kazatomtom, which is the primary company in Kazakhstan, put out some guidance the other day, which was for something like a 6 to 7% increase in its production for this year.
Yep.
Which, of course, in itself is only...
So what's that in global terms? Yeah.
And so that's only about 2.1 million pounds of uranium, which in the context is the same as a small uranium mining company.
Right. So it's not game changing.
It's like a Lotus Resources or something.
Right.
So it's not game changing in any way. And I think people just didn't understand what they heard and acted on it rapidly, and hence you've seen a correction in a lot of uranium stocks. But I think before you start worrying too much about uranium, at the same time, this coincided with news about a possible recession in the US. So we've seen lots of stocks go down, have corrections in the last few days,
a lot of red on the screen this
including
week.
Australian banks and things, and other commodities stocks. So, it's not the end of the world at all by any means for uranium stocks.
And I guess when you're looking at uranium stocks, there's lots of different categories. Would you put up the top of your list of sort of must-have uranium stocks, the current producers or those nearing production? Is Paladin Energy's just commenced production?
They're just commenced.
Correct.
It depends. I guess it depends on your risk appetite. It depends on what's happening in the broader market. But at this point in time, you really want to look at a company that's actually producing uranium, or alternatively just on the cusp of producing uranium.
So to list the stocks.
So the stocks in that category would be Paladin and Boss Energy.
And
they're
also close by Lotus.
And then Lotus is got a project
funded in it,
which is about 2 years behind, but that's a certainty, the reopening of existing plants. And then you've got a company called Bannerman, which is further behind. They've got a project, but they haven't even started construction yet. So it's a bit further behind. So the risk and the outlook is obviously different depending on on that degree, whether they're in production or not.
And everyone's circumstances are different, but like what we do is in the risk rating, we gauge the risk of each companies, and people can see in our research Bannerman Energy's a higher risk at 5 than say a Boss Energy or a Paladin at 4.
Yeah.
So they're all on the high risk spectrum, but some are much higher than others.
Yeah.
So moving on, like to another commodity that is really in the epicenter of news flow, lithium. I mean, there's been fortunes made and not necessarily lost, but it's certainly been a big return or decline in the lithium price from great heights. What would you say quickly just about lithium?
Well, I mean,
as a commodity?
I guess the price went to huge heights, and I suppose that attracted a lot of capital and so forth.
A lot of projects.
And so then at the same time, the demand for electric vehicles and other use of lithium are sort of falling a bit behind. I don't think it's ended. I think it's still ongoing.
Fallen a bit behind from expectations.
Yeah. I mean, I guess you look at the number of EVs on the roads are not probably as many as what you might have expected, or maybe not here, but other countries, particularly probably the US, where it's lagging a little bit, and car companies scale back their production rates for EVs.
Yeah, and hybrids have sort of taken up a bit of the slack.
It doesn't mean to say that, but it doesn't mean to say that's a permanent stoppage. The trajectory for EVs is probably still as high as it ever was, but we still need to wean us off oil and petrol. That's still the imperative. But it's really just the time scale, the schedule is probably a bit behind.
And would you say, from a stock perspective, are there some places you would prefer to be than other places?
Well, just like uranium, you prefer to, at this point in time, you prefer to be with a company that's either already producing or very close to producing. And the ones we particularly like are Pilbara Minerals, which is proven itself very profitable, started paying a dividend.
Yep.
Another one we like is Liontown Resources.
Yep.
That's behind, but similar sort of project, but only just beginning to ramp up production now.
And you've written recent notes on Argosy and Lake, haven't you?
Yeah.
So they're at the a bit smaller scale, aren't they?
They're at the smaller end
they're sort of in the sort of market caps of 50 to 100 million versus well over 2 billion.
Well, they've both got big resources.
Yep.
So from that perspective.
Right. So they're real viable projects.
So they're viable projects, but the problem is that, they're not developed yet.
Yeah.
And it'd be more difficult for them at this point in time to raise capital. And then you're still several years away from production.
And there is a technology aspect, isn't there, with Lake Resources in particular?
Well, there is. I mean, they're looking at a direct leach process to produce the lithium, which potentially is quite groundbreaking. All the test work they've done recently has been very good.
And I think once again, your takeout for investors, for members, is hold on, but some stocks are riskier than others, aren't they?
Yeah, I mean, it's not, I think they'll come good eventually, but there's always an issue. If you're not in production, they've got to go through the phases of raising capital,
still
potentially more dilution. So the risk scale is increased for a small company still looking to get into production rather than something that's already established.
Yeah, so Argosy and Lake are much higher risk than Liontown and Pilbara. This is another one where we've seen big swings in the commodities price, rare earths. I mean, can you just tell people what rare earths are and why they're in demand and what's been behind, I guess, recent selling?
Yeah. Well, rare earths aren't rare as such, but they require a lot of technology to produce a final product.
Yep.
So they occur in clays and rocks and things, but then you still need to spend a lot of money, a lot of technology, a lot of work involved to produce the final very pure
there's
product.
a lot of production risk.
And they used a number of high-end areas of technology, but particularly in the context of the energy transition, particularly for magnets, which are used in electric vehicles.
Right.
And because they're very concentrated, high-power magnet, the weight for weight, they're a lot less than a traditional magnet in a vehicle.
And long-term followers of Linus will know that there's political considerations. There's all sorts of stuff going on underneath the surface, literally, like with rare earth production. Yeah. Is Linus the best in class in your view?
In the sense that, I mean, the world's looking for production outside China, and really Linus is
All the world outside of China.
Outside of China, what did I say? Outside of China.
Well, our Chinese subscribers, we want to just...
And Lynas is the really only rare earths producer of that sort of size,
Right.
which is beyond the pilot plant stage. It's at full commercial scale. It's about the only one. Well, I won't say there's one in North America, which is slightly smaller. But I mean, basically, to all intents and purposes, it's really a very unique vehicle that's in production now, has been in production for several years, is expanding, and it's a very viable investment.
And would you say, in terms of the the commodity price end of it, how much would you say commodity prices need to rebound for Lynas to really see that free cash flow ramp up?
Well, quite a bit. I mean,
Right.
well, it's profitable now, but I mean, really, the opposite. You'd want to see rare earth prices much higher level to give a much better rate of return.
Yeah. And is there a catalyst for that?
I think the major catalyst would be something like the West, the US, whatever, decides to wean themselves off anything from China.
Yep.
And so they're prepared to pay a premium
Yep.
to source something from what you might call a secure regime outside of China.
Arafura, they had a capital raise recently, didn't they? Or a debt raise, and that was well supported. So I guess there is some big money behind these sort of companies.
It was more than big money. It was government support as well.
Right. So
It was
US government?
Well, I think it may have been the US government, particularly the Australian government that was providing their backing. And of course, they've got agreements with the US on supply anyway, so it's linked indirectly to the US.
Yeah.
So clearly, there's a lot of political support and will to get these projects off the ground.
Yeah, and that's key in mining.
And Europe's obviously very keen to get supplies that had nothing to do with China.
Yeah. And in relation to more traditional supply, traditional forms of energy, like gas. Now, gas is in a very we're talking politics, we're talking resources. You can't go past gas when you're looking at that. And gas is very much a market by market proposition, would you say?
It is very regional, really.
Yeah.
Apart from LNG, that's global.
Well,
a lot of gas is tends to be very regional in terms of its use and
it's transport. much cheaper to pipe gas around than to produce it into liquid form. Yeah. But are those local prices increasing because of that differential, because of the international price from gas?
Well, obviously,
versus
they have,
especially in Australia.
Up until comparatively recently, they were quite isolated, had nothing to do with international pricing.
Right.
But obviously, if you've got a producer that has got the option of exporting or using it for the domestic market, there might be certain times when it's a better profit margin by exporting. But that's not always the case, because you've got extra shipping costs and things. But definitely, prices have gone up in this country. But part of that has not been just due to export markets, it's also been the cost of producing it.
Right, and we've watched Cooper Energy for a long time, and we've seen that company getting into lots of trouble with its Orbis gas plant, which has held back the share price. Do you think that those problems are over? And if so, Cooper Energy be one of your favourite?
I mean, I wouldn't say they're completely over, but they seem to have got most of the problems ironed out now.
Yeah.
So they're certainly talking about a much higher production rate closer to the capacity of the plant.
Yeah.
And they're also talking about expansion potential in one of the other basins where they've got an operational plant.
Oh, so as a Cooper shareholder, that sounds good.
So they've potentially got a lot of growth further down the track. Not immediate, but it's not just the one, the existing project in the Cooper Basin, in the Gippsland in Victoria.
And how would you compare that to, say, a WA-based company, Strike Energy? They've got gas shortages in WA too, don't they?
Well, they have. I mean, part of that's due to the fact that they're closing the coal capacity.
Right.
And then that provides increased market for gas.
And Strike's had some, news flow recently.
Yeah. So gas prices have increased enormously, doubled in WA, which is great for Strike, except they've had a problem, a geological issue, exploration issue, on South Erregulla, where the results weren't as good as what they thought.
Yeah, so and then we come back to the risk involved.
So that's cast a bit of a cloud on the company. They've got one producing project, a smaller one. They've got two projects, South Erregulla and West Erregulla, to commission and finance and everything. So they've just got a few headwinds, if you
And
like.
then we move back over to the East Coast. So we're taking you across Australia at the rate of knots. This is, this is like the fastest form of travel known to man here on Under the Radar Report. We're back on the East Coast with Comet Ridge. What are your thoughts there? I think it's sort of more a Queensland,
It's a Queensland
sort of play. Yeah.
Comet Ridge is quite interesting because the Queensland government has lent quite a lot of support.
Yeah.
Financial, but also and then
regulatory.
Yeah, that sort of thing, and offering more ground. So obviously the Queensland government's very keen that project or projects, are in production as soon
and they're
as possible.
sort of yet to be in production, aren't they? On the other hand,
they're probably about 2 years away.
Right.
So something like that.
So which would you prefer out of Comet Ridge and Cooper and Strike?
I mean, I guess you probably want to diversify, so you probably rather than have one, you probably have two, but probably Cooper and Comet Ridge seem to be probably less risk, if you like. Cooper in particular is the one that you'd probably...
Okay, well, Cooper is in production, and they've been through a lot of the hurdles that could still befall Comet. And then we get to oil, which is one commodity that's, although it's associated with gas, it's got really its own dynamics now, doesn't it?
Well, it's a different market.
Yeah, it's a different market.
I mean, they're connected sometimes. Sometimes you get gas when you find oil, but it's not always the case.
Yeah. Well, they're both petrochemicals.
Yeah.
But what would you say about oil at the moment? Because I guess there is demand for it, but it ebbs and flows, doesn't it, in terms of the...
I mean, the oil price recently has been very volatile.
It's been strong because of the Middle East crisis, I think.
Well, I mean, the Middle East crisis, sometimes you get shipping costs going up because you've got instability where the ships are transporting the oil.
Well, there's lots of blockages everywhere in the world at the moment.
Yeah.
Like, it's really still a commodity that's sort of stuck in a different age. But, like, what I like about Karoon, A, we've made really good returns out of it, and B, I think right now it's good value. So can you talk about Karoon just quickly, which has some oil fields out in Brazil, offshore Brazil?
Well, they start off in offshore Brazil, and they've just...
When are they going to pay a dividend?
Well, just about to say, I mean, they've just announced a sort of dividend plan. So
they're on the path.
On the track.
Yeah, they're bound to institutional pressure.
It's a combination of a dividend and a bit of a buyback as well. So they're talking about capital management, for the first time, really. Yeah. So I think that's.
Well, would you prefer to invest in Karoon to say a Woodside or a Santos or a Beach Energy?
Well, the thing about Karoon is it's basically an oil producer. They produce a bit of gas in the Gulf of Mexico, but it's primarily oil, and it's a fairly simple sort of business. Whereas once you start looking at Woodside and Santos, you've got all sorts of issues regarding, they've got projects, but
they're huge.
But will those projects ever go ahead? Then you've got to fund them, or a lot of environmentalist problems.
Yeah.
So
because they're smaller, there's less hurdles for them to overcome.
I think it's less hurdles.
And it's more direct exposure to the oil price rather than the companies.
Well, I mean, if you look at the Karoon share price, for good or for bad, it's been quite volatile recently. Because the oil price has been volatile. So at least what that's telling you is that the Karoon is doing what it should be doing, which is basically providing a way of getting exposure to the oil price.
Yeah. And we're almost done, and thank you so much for your time. We can't go past nickel and copper because BHP have been heavily involved in both for very different reasons. On the one hand, they're getting out of nickel. On the other hand, they're doubling down on copper. Let's talk about nickel first quickly. I mean, that has really been hit hard, hasn't it, nickel?
Well, nickel was considered for use in lithium-ion batteries as one of the key components. So, of course, that's why BHP and others doubled down on their investment in nickel and others.
Yep.
And concurrently, you had massive investment, mainly driven by the Chinese, but into Indonesia, producing...
Right, yeah. That lower grade nickel that's cheaper.
Producing like a nickel, which is mainly used as a feedstock for making stainless steel.
Yep.
But it's still nickel.
Yeah.
And there's been massive growth there. And it's really just flooded the market with nickel. So though it's nickel in a different form, which most of it you can't use in batteries, nevertheless, the price of nickel has collapsed.
Yeah.
So the same prices applying to something that's very high in terms of its carbon footprint to a nickel from a sulfide, which is used in batteries with a low footprint.
Okay.
But it's still being priced the same. So as long as that's considered, it continues.
So what does Centaurus Metals? They're on the higher grade, the sulfide, aren't they?
They've got a really good asset in Brazil, which has got a bigger resource, but capable of massive increases from there, and 20,000 tons of nickel in
20,000 tons. Yeah.
That's the production rate planned. It's not in production yet. Production's still 2 or 3 years away.
Right.
But clearly the share price is right down because the nickel at the moment price is.
So would you be holding on to Centaurus?
Well, I would probably hold on to it because it is seen to be heavily backed or well backed by people that want it to succeed with the battery makers.
Okay.
And people that can offer finance.
Yeah.
But obviously because the nickel price is so low at the moment, there's obviously some risk there. You can't get away from the risk.
Which is why on their risk rating it's at the highest level. And with copper, that's a different sort of scenario where some of the independent copper producers have been purchased, I guess. So there's what's left to Sandfire and BHP. With copper, that's had quite a bit of an uptick, although
Well, it hasn't really. I mean, it was an uptick from the $3 something to $4, but it went right to $5.
Right, and it's come
and
back
now
to
it's
$4.
back to about $4.10 or $4.15 or something.
Yeah.
So obviously that has its effect on copper stocks.
Yeah.
And I think a lot of the reason for that, I mean, it is a transition metal, will be heavily used.
It's a transition metal.
Yeah.
Really?
In the energy transition.
I would have thought it's
because it's used in
batteries.
It's used in everything electrical, EVs and things. They use more copper than a conventional car.
Oh, right.
Yeah. So, and all sorts of things. As you electrify the economy, you need more and more copper.
Yeah.
So we need copper, but the thing is that at the moment, a lot of the extra copper, which might be needed and would be affecting the share price, is offset by reduced demand at the moment in China, because China is the largest copper consumer.
Yeah.
And I suppose when China catches a bit of a cold or a bit of a slowdown, that impacts the copper demand and the price goes down. So for the moment, the copper price has been very disappointing.
It has been, but would you say that BHP is a better exposure for people looking to copper than, say, a pure play like Sandfire? Because BHP obviously has, iron ore and...
Yeah. Well, I mean, the work I've done on BHP in the past shows that it's actually very leveraged.
Yeah.
So an increase in this to $5 then on to $6 makes a massive effect on BHP's earnings.
Yeah.
So provided the iron ore price...
That's one of the real sort of benefits of owning BHP.
I think it's got the largest resources in the world of copper.
Yeah, best can beat it.
And he's probably about the second largest producer in the world. So, but of course it's not a pure play, but it's still very leveraged to copper.
Yeah.
So that's one thing. I mean, Sandfire is a way of playing it as well, but it is a pure play, but it's also a more expensive way and high risk, and so forth.
Well, I mean, I think for anyone interested, we cover BHP in our blue chip publication, and we've written about that stock recently. But I'd add that all your circumstances are different, and looking at each stock is the key. But diversification is what we promote at Under the Radar Report, and it's never more important than in resources. But I guess the point is to really get to know these stocks and to read Peter's research, because commodities really can change your life. Yeah. Thank you, Peter.
Thank you, Richard.
Okay.
Bye.